There's a massive amount of commercial real estate debt coming due in the next 3 years to the tune of $1.5 trillion. And our next guest says that it's a, quote, slow-moving train wreck. Joining us now is Scott Rechler, CEO of RXR, a real estate manager and developer that owns properties across the U.S. Scott, it's great to have you on the show.
Thanks, Morgan. It's great to be here.
You've talked about this before, this slow-moving train wreck. What do you mean by it?
Yeah, what we've been experiencing in the commercial real estate space is this historic interest rate rise has thrown a lot of these loans off balance at the same time that banks and other lenders are under pressure to stop lending to commercial real estate. So we have this spike in rates, which meant that loans that were financed when rates were near zero and now have to be refinanced at rates that are 2 to 3 to 4 times more than it was before, so they don't work. And there's much fewer lenders that are willing to actually make those loans to those potential borrowers. So we're facing a credit crunch across the whole commercial real estate space. And then on top of that, as it relates to office and multifamily, you have some strong fundamental challenges, offices on the remote work and people trying to understand the future of office space and the level of demand there. And for multifamily, a surge of record supply of new units that are coming to market right in the face of this challenging credit period.
So on a day where we had a softer inflation print and investors are cheering that maybe we are indeed getting closer to the end of a Fed rate hiking cycle, this idea that you could see higher for longer in rates, that's really the risk here over the coming months and years.
That's right. And the thing, why it's a slow-moving train wreck, which, by the way, will eventually pick up speed, is because as loans mature, they have to be refinanced from rates that could be as low as 2% to now 7, 8, 9%, right? And so that could be 1 year out, 2 years out, or 3 years out. So if it's higher for longer, every time those refinancings occur, that's where the challenges occur, particularly for the multifamily space. On the office space, it could happen earlier than that because many of these buildings require capital invested, and people don't want to invest capital without having balance sheets that are in balance. And so they need to be addressed more quickly.
Scott, is there a way perhaps that this gets resolved that we're not seeing? There's that saying in the industry, if I owe the bank $500,000, it's my problem. If I owe the bank $500 million, it's the bank's problem. There's such a big debt bomb across so many different banks and so many different places. Might there be some either government or bank industry-wide solution that causes this to play out in a way that's different from what we all expect?
Yeah, first, I think you're right. If we can get some, government action, which we've had some, which I'm pleased, this past month, the regulators came out and, put down an edict that lending institutions should work with responsible borrowers where they can actually restructure loans or, provide some relief during this period of illiquidity. But what we really need is fundamentally we need the market to actually have more liquidity, right? These loans need to be re-equitized. I mean, Green Street came out this morning with a report that said, for example, that office building values have come down about 30% and multifamily values have come down 16%. That's for the value of the building. If you think about just the equity, which if someone puts 65% debt on it, from the office building owner, your equity is worth zero. From the multifamily owner, it's about half. So you need to re-equitize that. And that means you need to have the private sector come in and work with the lending sector, the lenders, to actually put new equity in and rebalance those loans as we go through this. We're doing it at RXR as an example on the office buildings. Right now, we have about $2 billion of office building loans, but to refinance them, the only lender that will do it are the existing lenders, and we're investing $700 million more as part of those refinancings to rebalance those buildings. Now, we can do that, but now you got to take that across the entire country to small owners, small operators. That's very challenging. And so we need to start creating liquidity in the marketplace, creating transaction, creates price discovery, and then hopefully that unclogs the plumbing. And then, John, to your point, that should enable us to re-equitize, but it's going to come with pain. There's no doubt there's losses going to be here, right? The borrowers are going to have losses. The lenders are going to have losses. The regional banks are going to have, heavy concentration on this. And so there's going to be challenges ahead. This is not going to be smooth, and it's not going to be without some level of pain.